Do you have any experience buying company shares because their CEO is well known or because their brand appears perfect? The halo effect is a cognitive bias that causes us to evaluate all aspects based on a single positive characteristic. The halo effect leads to dangerous investment mistakes. Investors tend to believe that a well-known founder, a shiny ESG rating, and market-leading brand status guarantee investment success. The halo effect creates illusions that mask the company's underlying problems. A company that achieves success through marketing efforts will likely struggle with profitability. A leader who presents himself as charismatic might use this image to hide poor financial performance. Our brains seek straightforward explanations because we prefer to understand things through simple narratives with defined heroes. The market operates as a financial document rather than a fictional story. Our tendency to associate charismatic leaders with strong financials and reputations with success leads us to spend more on image than on actual value. To fight against this psychological error, review financial statements rather than relying on media reports. Evaluate leadership appeal independently from business sustainability. Performance. Base your decisions on actual data instead of emotional responses. Spread your investments across multiple investments because one successful company should not control your entire investment portfolio. The market offers better returns to investors who focus on precise financial data rather than charismatic leaders. Investors who want to succeed need to see beyond surface appearances to discover the actual worth of their investments. If you like such investment and wealth insights, please subscribe to Financial Freedom with Benis Kumar Moses channel for daily posts. See you in the next video.